Today we are going to talk about methods to reduce or avoid double taxation in an international context. Imagine you're the manager of a domestic corporation that expands abroad in the form of a foreign direct investment and gains profits. In case of a simultaneous application of the worldwide and territoriality principle, international double taxation occurs. Countries can adopt the credit or exemption method to reduce or fully mitigate international double taxation. In this video, we are going to talk about the tax implications of the credit method. The credit method affects the domestic taxes to be paid. The profits of an investment are subject to corporate income tax in the foreign country. In addition, cross-border payments to the parent company may be subject to a withholding tax in the foreign country. To reduce or avoid double taxation, the domestic country may allow to credit the foreign taxes against the domestic tax liability of the corporation, which reduces the amount of taxes payable in the domestic country. There are two forms of the credit method, the direct and indirect credit method. Under the direct method, only foreign withholding tax can be credited against the domestic tax liability, while the indirect method considers both foreign withholding tax and foreign corporate income tax paid. You wonder about the implications of the credit method on the overall tax burden. We distinguish two cases. First, if the domestic tax liability is higher, the foreign taxes paid is fully offset against the domestic corporate income tax liability. Therefore, the overall tax burden equals the domestic corporate income tax. Second, if the domestic tax liability is lower, the foreign tax credit exceeds the domestic tax liability. Most countries do not allow for a tax refund. Thus, the overall tax burden equals the foreign taxes. Since taxpayers can offset the foreign taxes against the domestic tax liability, the higher of both tax liabilities determines the overall tax burden. Thus, even if domestic taxes paid are higher than the foreign tax liability, the foreign investment is not tax advantageous. In contrast, if the domestic tax liability is lower, a foreign investment is less tax efficient, as excess foreign tax credits are not refunded. To summarize, under the credit method, the taxpayer can offset foreign taxes paid against the domestic tax liability. Thus, the higher of both tax liabilities determines the overall tax burden. Under the credit method, double taxation is mitigated, or even avoided, if the foreign taxes paid can be fully offset against the domestic income tax liability. As an alternative to the credit method, a country can apply the exemption method. This will be explained in a separate video.